Everyone sees the AI bubble coming. $5 trillion valuations, $300 billion deals. Even Sam Altman admits investors are overexcited, but they're all staring at the wrong number on the screen. Right now, as I'm speaking, physical silver is selling for $130 per ounce in some markets. The price on your screen? $72. That's a $60 gap for the same metal, and it's getting worse every single day. If you want to catch market moves before they explode, subscribe now. What I'm about to show you isn't being covered anywhere else, because in 2025, silver didn't just go up, it detonated. 160% gains, all-time high of $86.62 on December 30th. It crushed gold's 64% return. It beat Bitcoin's best runs. It outperformed the S&P 500. It outperformed everything. And I need you to understand something crucial here. This wasn't retail investors on Reddit driving a meme squeeze. This wasn't hedge funds playing games. This was something far more structural, far more dangerous, and far more inevitable. For 5 straight years, we've consumed more silver than we've produced. The Silver Institute confirms it. 800 million ounces. Gone. That's a full year of global mining production. Just vanished into solar panels, electronics, and electric vehicles. Now you might be thinking, okay, so we used some stockpiles. We can recycle it later, right? Wrong. This is critical. Recent studies show it costs over $300 per ounce to extract silver from landfills. $300. When current prices are $70 to $75 on paper, that silver sitting in old phones and discarded electronics, it's economically gone forever. You'd lose $225 on every ounce you tried to recover, so that 800 million ounces, it's not coming back. Now here's where your brain should start firing warning signals, because the demand situation is unlike anything we've seen in commodity markets. 59% of silver demand is industrial, not jewelry, not coins, not speculation. Industrial. And here's what makes this terrifying. Industrial demand is price inelastic. These manufacturers need silver. They can't just substitute it away. Let me break down the numbers because they're absolutely staggering. Solar panels consumed 232 million ounces in 2024. In 2015, it was just 60 million. That's a 287% increase in under a decade. And the International Energy Agency projects solar capacity will expand by 3,200 to 4,400 gigawatts by 2030. Do the math with me. That's 300 million ounces annually just for solar. And get this, the new efficient TOPCon solar panels, they require 50% more silver per panel than old technology. So as panels get better, they consume more silver, not less. Electric vehicles use 67 to 79% more silver than gas cars. Every battery management system, every power electronic, every charging connection. Silver. The Silver Institute forecasts automotive demand growing at 3.4% annually through 2031. 5G infrastructure needs 13 million base stations globally. Each one requires silver connections because nothing else conducts electricity like silver does. Medical technology using silver's antimicrobial properties, which are 99.9% effective against bacteria, is expanding rapidly. And here's the kicker that most analysts are completely missing. AI data centers? Yes, the same AI boom everyone thinks is a bubble. Every server, every switch, every advanced computing component needs silver. Global IT power capacity increased by 5,252% from 2000 to 2025. That's not a typo, 5,200%. Every single watt of that infrastructure contains silver components. But wait, because I need to tell you about something that could change everything. Samsung just announced a solid-state battery technology using silver. It charges in 10 minutes. It runs over 1,000 miles. If this technology scales to mass production, we're talking about hundreds of millions of additional ounces of annual demand that doesn't even exist in current forecasts. So demand is exploding across solar, EVs, 5G, AI, medical tech, and potentially revolutionary battery technology. Surely supply can just increase to meet demand, right? Here's the nightmare scenario. Silver production peaked in 2016 at 900 million ounces annually. Last year, 2025, 835 million ounces. Production dropped 7% despite silver prices more than doubling. Read that again. Prices doubled. Production fell. How is that even possible in a normal market? Because 70% of silver comes as a byproduct of mining copper, lead, zinc, and gold. This is absolutely critical to understand. When you mine copper, you get some silver as a secondary product. But copper miners don't suddenly dig faster or open new mines just because silver prices went up. Their economics are based on copper prices, not silver. Supply is inelastic. It physically cannot respond to price signals the way normal commodities do. And even if miners wanted to open new primary silver mines, permitting now takes 7 to 10 years on average. Environmental regulations, community approvals, infrastructure development. A mine you start planning today won't produce an ounce until 2035. The Silver Institute projects a supply deficit of 120 million ounces for 2025 alone. CPM Group estimates it could be as high as 206 million ounces, 5 consecutive years of deficits. Inelastic supply, explosive demand, recycling economically impossible. New supply 7 to 10 years away. If this were oil, wheat, or copper, every economist would be screaming about the impending supply crisis. But with silver, something very strange is happening. The price action doesn't match the fundamentals at all. And that brings us to what happened 3 days ago. January 1st, 2026, China implemented the most significant structural change to global silver markets in modern history. New export licensing requirements went into effect. And this isn't bureaucratic paperwork. This is China, which controls 60 to 70% of global silver refining capacity, putting a chokehold on international supply. Under the new rules, only massive state-approved companies with annual production exceeding 80 tons can even apply for export licenses. Small and mid-sized exporters completely shut out. Done. Even Elon Musk tweeted about this. This is not good. Silver is needed in many industrial processes. Why would China do this? Officially, environmental protection and resource conservation. But let's be adults here. This is strategic resource nationalism, pure and simple. China designated silver as a critical mineral, just like they did with rare earths, tungsten, and antimony. These are economic weapons, tools of leverage in the ongoing trade war. In October 2025, right before the restrictions hit, China exported a record 660 tons of silver. Why the sudden surge? Front running. Companies knew the window was closing and shipped everything they could before the door slammed shut. Starting January 1st, that flow stopped. But here's what makes this truly explosive. China isn't just restricting exports. They're the world's largest consumer. Over 50% of global industrial silver demand comes from China. Their solar industry alone is devouring supply at unprecedented rates. Think about the position they're in. They produce silver, refine most of the world's silver, consume most of the world's silver, and now they're restricting everyone else's access to it. This is the textbook definition of a supply squeeze. And the physical market is already showing massive cracks. This is where things go from concerning to absolutely insane, and I need your full attention here. On December 24th, 2025, physical silver on the Shanghai Gold Exchange closed at $78.49 per ounce. The COMEX futures price that same day? Around $70. That's an $8 premium just to get real metal in Asia, but it gets so much worse. Right now, today, some dealers are reporting physical silver, actual bars and coins you can hold in your hand, selling for $110 to $130 per ounce. Meanwhile, the spot price on financial websites shows $70 to $75. Let me repeat that. The same commodity is trading $60 apart, depending on whether you want paper or physical. How is this possible? How can silver be $70 and $130 at the same time? Welcome to the greatest disconnect in modern financial markets. COMEX, the commodity exchange in New York, sets the official silver price. But COMEX is primarily a paper market, futures contracts, derivatives, financial instruments that represent silver but aren't actually silver metal. On COMEX, approximately 750 million ounces of paper silver trade every single day. That's almost an entire year of global mine production trading in 24 hours. And here's the key. Less than 1 to 3% of those contracts ever result in physical delivery. For every physical ounce of silver that actually exists, there are estimated to be 100 to 378 paper claims on it. Let that sink in. 378 people or institutions think they own the same ounce of metal. This fractional reserve system worked perfectly fine for decades. Most traders just closed their positions in cash. Nobody actually wanted delivery. The music kept playing until December 2025. In just the first 4 days of December, 60% of COMEX registered silver was claimed for physical delivery. 60%. In 4 days. Alarms started going off across the financial system. And here's where it gets really interesting. The Shanghai COMEX arbitrage completely broke down. Under normal market conditions, if Shanghai is paying $8 more per ounce, arbitrage traders should immediately buy on COMEX, ship the metal to Shanghai, and pocket the difference. This arbitrage opportunity should close the price gap within days, maybe a week at most. It's not closing. The gap is widening. Why? Because when traders try to actually take physical delivery from COMEX to ship to Shanghai, they're discovering something uncomfortable. There isn't enough metal available to move at scale. COMEX registered inventories, the silver that's actually available for delivery against futures contracts, are down nearly 70% since 2020. The London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai Futures Exchange warehouses just hit their lowest level since 2015. The world is systematically running out of easily accessible, above-ground refined silver. Meanwhile, the paper market continues trading hundreds of millions of ounces daily, setting a price that has increasingly no connection to physical reality. This is a fractional reserve system under extreme stress. And if you know financial history, you know what happens when fractional reserve systems get tested by actual demand for the underlying asset. Now, I want to be very careful here, because the word manipulation gets thrown around constantly in precious metals. But with silver, we're way past conspiracy theories. We have documented, prosecuted, admitted in court cases. September 2020, JPMorgan Chase paid $920 million to resolve criminal charges for manipulating precious metals markets through a practice called spoofing. That's placing large orders they never intended to execute, purely to move prices in their favor. Deutsche Bank settled a silver price fixing lawsuit in 2016 for $75 million and agreed to cooperate with ongoing investigations into other banks. These aren't allegations. These are settled legal cases. Major banks admitted guilt and paid massive fines. The manipulation mechanism is actually elegant in its simplicity. Use massive paper positions to suppress prices while quietly accumulating physical metal. When you can trade 100 times more paper silver than physical silver exists, you can overwhelm natural price discovery. You can make the price whatever you want, at least temporarily. JPMorgan, one of the most respected silver analysts in the world, said it plainly: when you see a silver price, you see a derivative price. The spot price is pretty much derived from what we call the near month, and that's done by a bunch of paper contracts. And here's the mechanism that makes the whole system work. COMEX can force cash settlement. If you bought a contract expecting to take delivery of physical metal, COMEX can simply say, sorry, here's cash instead based on our paper price. For financial traders, that's fine. They just wanted price exposure anyway. But for industrial users, for solar panel manufacturers who need actual silver to coat their panels, for electronics manufacturers who need real metal to solder components, they can't use cash. They need physical silver. And when the paper market can no longer deliver physical metal, when the derivatives system breaks down because there simply isn't enough metal backing all those paper claims, something has to give. Price becomes the only mechanism that can force truth back into the market. And that's when the real bubble reveals itself. Here's the insight that changes everything, and I need you to really understand this because it's counterintuitive. Silver is not in a bubble. The paper price of silver is in a suppression bubble, and that suppression is finally breaking. When people talk about the AI bubble, they're talking about overvaluation. Prices too high relative to fundamentals. Too much money chasing speculative returns. Companies worth trillions with no path to profit. That's a normal bubble. Prices going up beyond what's justified. Silver is the exact opposite. It's a suppression bubble. Prices held artificially low relative to fundamentals for decades. And what happens when a suppression breaks? You don't get a slow deflation back to fair value. You get violent, explosive price discovery to the upside as the market tries to find the real clearing price. Look at every single fundamental again. 5 consecutive years of supply deficits totaling 800 million ounces. Inelastic supply from byproduct mining that cannot respond to price signals. Explosive industrial demand from unstoppable megatrends. Solar energy, electric vehicles, 5G networks, AI infrastructure, medical technology, potential battery revolution. China restricting 60 to 70% of global refining capacity and export flows. Physical silver already trading at premiums of $50 to $60 above paper prices. Inventories at multi-year lows across every major exchange globally. Paper to physical ratios of 100 to 1 up to 378 to 1. Documented and prosecuted manipulation by major financial institutions. Recycling costs at $300 plus per ounce, making recovery completely uneconomical at current prices. Every single one of these factors points to one inevitable conclusion. The current price is a fiction. It's maintained by a paper derivative system that's running on fumes. When this system breaks, and it's a question of when not if, silver will experience price discovery that makes 2025's 160% gain look like the warm-up act. Some analysts are projecting $150 to $200 per ounce by 2027. Veteran precious metals expert Mike Maloney has mentioned potential for $300 per ounce during what he calls a mania phase. But here's what separates this from wild speculation. These projections aren't based on hype or hope. They're based on the mathematical reality that the supply deficit has to resolve somehow. If you can't recycle silver economically below $300 per ounce, and mines can't produce significantly more due to byproduct constraints, and industrial demand keeps growing from solar and EVs and AI infrastructure, then price must rise to the point where one of 4 things happens. 1, demand destruction. Industries literally shut down because they can't afford silver at the clearing price. 2, substitution becomes economical. Gold, platinum, or other metals replace silver, but that only happens at much higher price ratios, probably near 1 to 1 with gold. which would put silver over $4,000 per ounce. 3. Massive new supply comes online, but that takes 7 to 10 years minimum from discovery to production. Or 4. Physical delivery failures on COMEX. The paper system admits it can't deliver, and the entire precious metals pricing mechanism breaks down in a crisis of confidence. Any single one of these outcomes means dramatically higher prices. The bubble that's bursting isn't silver going up, it's the suppression finally breaking after decades of paper manipulation. So while everyone is worried about AI companies burning through cash and overpaying for data centers, while they're concerned about tech stocks trading at 23 times forward earnings, the real systemic risk is hiding in plain sight. It's in a metal that's trading $60 apart between paper contracts and physical bars. It's in a market where 378 paper claims exist for every single real ounce. It's in a commodity experiencing its 5th consecutive year of deficits, while inventories collapse worldwide. It's in an industrial metal that's critical to solar, EVs, electronics, medical devices, defense systems, space technology, 5G networks, and data centers, with no substitute available at current prices. The AI bubble might hurt tech investors in Silicon Valley. That's painful, but it's contained. The silver bubble breaking will cascade through every major industry on Earth. When solar manufacturers can't get silver, renewable energy installation stops. When EV makers can't secure supply, vehicle production halts. When electronics manufacturers lose access, supply chains freeze. When medical device makers face shortages, healthcare technology stalls. This isn't just an investment opportunity or risk. This is a structural crisis in a metal that underpins the entire electrification revolution and technological advancement of modern civilization. When this bubble truly pops, when the paper-physical disconnect becomes so obvious that it can't be ignored anymore, it won't just create windfall profits for people holding physical silver. It will expose just how fragile our entire financial pricing system really is. It will force regulators and markets to confront the reality that massive paper markets have been setting prices with almost no connection to physical availability. The biggest bubble is not AI. It's the decades-long suppression of silver prices below the cost of physical replacement, maintained by paper derivatives that have multiplied hundreds of times beyond the actual underlying asset. And that suppression bubble is cracking right now, in real time as we speak. The question isn't whether it will break completely. The question is whether you understand what's happening and whether you'll be positioned correctly when it does. If this analysis opened your eyes to something the mainstream financial media isn't covering, hit that subscribe button right now. This is the kind of deep research that can put you ahead of major market moves. Drop a comment below. I want to know what you think about this situation. Are you buying physical silver? Do you think the paper system can hold together? How high do you think prices could go when this breaks? Let's have a real discussion in the comments. And remember something important as you navigate these markets. In a world filled with paper promises, digital claims, and derivative contracts, sometimes the most powerful truth is simply holding something real in your hands.